When you think about fixing a tax mistake, your mind probably jumps straight to the IRS, right? But what if I told you the real minefield, the truly tricky part, is often your state's Department of Revenue? Let's dive in and really uncover why amending a state return can be so much more complex and, honestly, more dangerous than dealing with the feds. All right, we're going to conduct a bit of a forensic investigation here. First, we'll peel back the layers of what I call the federal illusion, this idea that everything is simple. Then, we'll uncover the state trap and what makes it so darn different. From there, we'll look at why states can be so much more aggressive and offer you weaker protections. Then, get this, we'll expose a hidden financial threat to seniors called the Retiree Double Torpedo. And finally, we'll deliver our forensic verdict on the whole situation. So, let me ask you this. You find a mistake on your tax return. Maybe it's a missed 1099, a simple math error. You probably think fixing it is just a matter of filing a quick correction, right? While what mainstream advice calls a simple correction, forensic reality shows is often a super nuanced, high-stakes game, especially at the state level. Okay, let's start with what most of us know and are familiar with, the federal system. Its whole structure and its procedures, they create what we can call a federal illusion. It gives you this false sense of security that all tax amendments are supposed to work this way. I mean, think about it. The IRS has one standardized form, the 1040X, and a massive public body of rules and guidance. This unified structure gives everyone a clear path, and the rules are exactly the same whether you live in California or you live in Maine. But this familiarity, this is precisely what sets the trap when you turn to your state return. And now, let's get to the core of our investigation, the state trap. This is the part where that familiar federal rulebook you thought you knew gets tossed right out the window. Suddenly, it's replaced by 50, count 'em, 50 different sets of rules, deadlines, and attitudes. At the very heart of this problem is a concept called decoupling. See, just because the federal government accepts your amended return, it doesn't mean your state will automatically do the same. States can literally pick and choose which parts of the federal tax code they want to adopt. This is exactly why you can win your case with the IRS and still end up losing with your state.
So states generally handle this in one of two ways. With rolling conformity, the state code updates automatically along with the federal one. Simple enough. But with static conformity, oh, that's where things get really tricky. A state might base its laws on the federal code as it existed on, say, December 31st of last year. Any federal tax law change after that date, the state just ignores it. Imagine a new federal deduction is created in March. Well, too bad. You simply can't claim it on your state amendment because their code is frozen in the past.
And check this out. Look at the ticking clock here. The IRS gives you a pretty generous window to claim a refund, but many states, they have a much shorter fuse. You could literally get your federal amendment approved, have that refund check from the U.S. Treasury in your hand, and then go to file your state amendment only to be told, sorry, you're too late. That state window has already slammed shut for good. It isn't just that the rules are different, the entire enforcement vibe can be so much harsher. We're now entering the territory of aggressive states and weaker taxpayer protections, and this is where the power balance can shift dramatically away from you. Look, if you make a mistake, you're probably hoping for a little bit of leniency. The IRS often grants penalty relief if you have what they call a reasonable cause. But the states, the forensic reality is they often have a much lower tolerance for any error. They demand stricter proof, a lot of times requiring contemporaneous documentation. That's evidence created at the exact time of a transaction, not just some receipt you found later. Without that, your deductions can be disallowed in a heartbeat. And this right here, this is a big one. With the IRS, you can appeal a dispute in tax court before you pay a dime. But many states have what's called a pay-to-play system. They can assess the tax and start collection activities immediately. And if you want to fight it in court, you have to pay the disputed amount first. The burden is completely flipped onto you. And if you think this is all just theoretical, look no further than this real court case. The Conway v. Wisconsin Department of Revenue case is just a brutal reminder of this reality. The Conways amended their federal and then their state returns, but the court ruled their state amendments were invalid because they missed a tiny 30-day window after the federal change. The key takeaway here, a federal action does not stop the state's clock. Now, to really see just how devastating these complexities can be, let's zoom in on one specific group, retirees. For them, a simple state tax amendment can trigger something we call the double torpedo, a hidden financial strike that causes this awful cascade of consequences. It all kicks off with something called provisional income. It's the formula used to figure out if your Social Security benefits are taxable. But here's the kicker. A state tax refund is often considered taxable income by the IRS. So that refund increases your adjusted gross income, your AGI, which is the very first number in this dangerous calculation. A simple $3,000 state refund just added $3,000 to your AGI.
Now look at these income thresholds. It really doesn't take much to cross them. A state refund of just a few $1,000s could easily push a retiree's provisional income over that second threshold. And just like that, boom, up to 85% of their Social Security benefits are now taxable, when before, maybe only 50% or even none of it was. That is the first torpedo.
But wait, it gets worse. That higher AGI leads to a higher modified AGI, or MAGI. And MAGI is the number Medicare uses to determine your premiums. So the second torpedo strikes when that extra income triggers IRMAA surcharges. That's an income-related monthly adjustment amount. It's basically an extra fee tacked on to your standard premium, forcing you to pay more for Medicare. One state refund can literally lead to both higher taxes and higher healthcare costs. So after looking at all this evidence, it's time to deliver our forensic verdict and really wrap our heads around how to navigate this state tax minefield. So the state tax amendment trap is really defined by these 6 key dangers. First, decoupling, which just means federal rules don't automatically apply. Second, those much shorter statutes of limitations that can rob you of a refund you've earned. Third, you've got limited recourse and weaker protections like those pay-to-play systems. Fourth, there's often a lack of specialized state courts, so you might not get judges with deep tax expertise. Fifth, vague regulatory guidance can make it feel impossible to know the right answer. And finally, the state's right to disagree with the IRS means even a federal win guarantees you absolutely nothing. A cookie-cutter approach just will not work here. All of this brings us to one final, crucial question. Now that you've seen the trap, with all its hidden deadlines, its aggressive enforcement, and its cascading consequences, is your financial diligence still focused only on the IRS? Maybe, just maybe, it's time to give your state return the forensic attention it truly deserves.